Welcome to Banking Beyond. In this video we're going to explore the secrets behind the most profitable banks in the world. We'll uncover how these banks generate billions in profit. We'll dive deep into their operations, strategies, and what makes them financial powerhouses. From their day-to-day activities to their long-term plans, we'll take you from the bustling streets of New York City to the tech-driven metropolises of China and even the serene Swiss Alps, to show you how these financial giants influence the global economy. So buckle up because we're about to break down their winning formulas, step by step. Let's get started. Alright, let's talk about diversification. It's not just about your investment portfolio, folks. The most successful banks know that spreading their bets across multiple revenue streams is key to long-term stability and, of course, massive profits. Take JPMorgan Chase, for example. They're a prime example of this strategy in action. They're making money hand over fist from credit cards, home loans, investment banking, you name it. They're even managing the wealth of billionaires. This multi-pronged approach is genius. If one sector of the economy takes a hit, like the real estate market crashing, their other revenue streams can pick up the slack. It's all about minimizing risk while maximizing earning potential. Think of it like this. Would you rather have all your eggs in one basket or spread across multiple baskets? Exactly. Diversification isn't just about mitigating risk, it's about creating multiple engines for profit generation. JPMorgan, with its vast array of financial products and services, is essentially running several successful businesses under one massive umbrella. This allows them to capitalize on opportunities in different market conditions. When interest rates are low, their mortgage business booms. When the stock market is hot, their investment banking division thrives. By strategically diversifying, they're always in a position to win, no matter what the economy throws their way. Another great example of this is Bank of America. They've got their hands in everything from traditional banking services like checking and savings accounts, to wealth management, investment banking, and even insurance. This kind of diversification allows them to capture a wider customer base and cater to a variety of financial needs. It's like a one-stop shop for all things finance, which creates incredible brand loyalty and, of course, a whole lot of revenue. They've essentially positioned themselves as an indispensable part of their customers' financial lives. Need a loan? Bank of America. Want to invest your savings? Bank of America. Need insurance? You guessed it, Bank of America. It's a brilliant strategy for long-term success. So, what's the key takeaway here? Diversification is absolutely crucial for any bank that wants to achieve sustainable profitability. It's about spreading risk, creating multiple income streams, and positioning yourself to thrive in any economic climate. The most profitable banks understand this principle and have mastered the art of diversification. They're not putting all their eggs in one basket, and that's a major reason why they're raking in billions year after year. Remember, diversification isn't just a banking strategy, it's a fundamental principle for success in any business or investment endeavor. So, take a page from the playbook of these financial giants and diversify your way to a more secure and profitable future. Now let's talk about another key ingredient in the recipe for banking success: scale. Scale is not just a buzzword, it's a fundamental aspect that can make or break a financial institution. When it comes to the financial world, size really does matter. Larger banks have the resources to invest in cutting-edge technology, hire top talent, and offer a wider range of services to their customers. The bigger the bank, the better its ability to scale its operations efficiently and dominate the market. This dominance allows them to negotiate better deals, attract more clients, and ultimately generate more revenue. Take ICBC, the Industrial and Commercial Bank of China, for example. This bank is a prime illustration of how scale can lead to unparalleled success. This behemoth of a bank serves over 680 million customers in China alone. That's a staggering number, showcasing the immense reach and influence of ICBC. Let that sink in for a second. 680 million customers. Imagine the infrastructure and resources required to manage such a vast customer base. That's more than double the entire population of the United States. This comparison puts into perspective the sheer magnitude of ICBC's operations. With that kind of scale, they can spread their operating costs over a massive customer base, making them incredibly efficient and profitable. This efficiency translates to better services and lower costs for their customers. It's like the Costco of banking. Buy in bulk, keep costs low, and pass the savings on to customers while still raking in huge profits. This model not only benefits the bank but also its vast customer base, creating a win-win situation for everyone involved. Think about it, whether you're serving 1 million customers or 680 million, the underlying infrastructure costs for things like technology, branches, and staff don't increase at the same rate. This is the beauty of economies of scale. These massive banks can negotiate better deals with suppliers, invest heavily in cutting-edge technology, and streamline their operations to squeeze every last bit of efficiency out of their business. It's like a well-oiled machine that just keeps churning out profits. This allows them to offer competitive pricing to attract even more customers, further solidifying their dominance in the market. It's a virtuous cycle that smaller banks simply can't compete with. They're playing checkers while these giants are playing chess on a whole other level. You know, in the world of finance, it's all about managing risk. Every decision, every move, every investment is a calculated step on a very narrow path. It's like walking a tightrope. You gotta find that perfect balance. One misstep, and you could fall into financial ruin. Lean too far one way, and you could face massive losses. The market is unpredictable, and even the smallest error can have huge consequences. These top-performing banks, they're like seasoned tightrope walkers. They move with precision and confidence, knowing exactly where to place their next step. They've got years of experience, they understand the dangers, and they've got the skills to navigate them. They don't just rely on luck, they rely on expertise and careful planning. They're not gambling with their money, they're making calculated decisions. Every trade, every investment is backed by thorough research and analysis. And it's not just about avoiding losses, it's also about maximizing profits. They aim to turn every opportunity into a profitable venture. They're constantly assessing the risk-reward ratio, making sure that every move they make is going to generate the best possible return. It's a continuous process of evaluation and adjustment. That's the name of the game, right? It's about being vigilant, staying informed, and always being ready to adapt to new circumstances. You gotta be smart about it. It's not just about making money, it's about making the right decisions at the right time. These banks, they're not just throwing money at every opportunity that comes their way. They scrutinize every potential investment, weighing the pros and cons meticulously. They're being strategic, they're doing their due diligence, and they're making sure that they're putting their money in the right places. It's a disciplined approach that separates the successful from the rest. One of the biggest secrets to their success? Data. These banks are sitting on mountains of data, and they know how to use it to their advantage. They've got sophisticated algorithms and risk models that help them analyze every single loan, investment, and transaction. They're looking at everything: credit scores, income levels, market trends, you name it. They're crunching the numbers, identifying potential red flags, and making sure that they're minimizing their exposure to risk. It's like having a crystal ball, but instead of predicting the future, it's predicting potential losses. And trust me, in the financial world, that's even more valuable. This data-driven approach allows them to make informed decisions, optimize their portfolios, and stay one step ahead of the competition. But they don't stop there. These banks are constantly running stress tests and simulations, putting their portfolios through the ringer to see how they would perform under different economic scenarios. They're simulating recessions, market crashes, natural disasters, you name it. They want to be prepared for anything and everything. Think of it like a pilot practicing in a flight simulator. They're not actually flying a plane, but they're putting themselves through the same stressful situations, so they're prepared for anything. This rigorous testing allows them to identify vulnerabilities, adjust their strategies, and ensure that they're well equipped to weather any storm. But it's not all about algorithms and data. While technology plays a crucial role in modern finance, it cannot replace the nuanced understanding and intuition that humans bring to the table. At the end of the day, there's still a human element to risk management. This human touch is what makes the difference between success and failure in many cases. You need experienced professionals who can interpret the data, make judgment calls, and trust their gut instincts. These banks understand that. They know that data alone can't capture the full picture. They invest heavily in their risk management teams, hiring the best and the brightest minds in the industry. These experts bring years of experience and a deep understanding of market dynamics. They know that having a strong team in place is essential for navigating the complexities of the financial world. It's not just about having the right tools, but also the right people. It's like having a team of expert navigators guiding a ship through treacherous waters. These professionals are adept at reading the signs and making informed decisions. They're constantly monitoring the horizon, making adjustments, and ensuring that the ship stays on course. Their vigilance and expertise are what keep the financial institution steady. That's the power of combining data-driven insights with human expertise. It's a synergy that leads to more accurate predictions and better decision-making. That's how these banks are able to manage risk effectively and achieve sustainable profitability. By valuing both technology and human insight, they create a balanced approach to risk management. Let's be real, the banking industry is changing faster than ever before. Technology is disrupting everything, and the banks that are thriving are the ones that are embracing innovation. We're talking about artificial intelligence, blockchain, cloud computing, the whole 9 yards. These technologies are transforming the way banks operate, from customer service to fraud detection to loan processing. It's like stepping into a sci-fi movie. Remember those old bank branches with long lines and mountains of paperwork? Yeah, those days are long gone. The banks that are staying ahead of the curve are the ones that are investing heavily in technology and using it to create a better customer experience. Take JPMorgan Chase, for example. They're investing billions of dollars in artificial intelligence, and it's paying off big time. They're using AI to detect fraud, personalize customer experiences, and even make investment recommendations. Imagine having an army of robots working around the clock to protect your money and help you grow your wealth. That's the power of AI in banking. And it's not just about saving money, it's about making money too. By using AI to analyze market data and identify investment opportunities, JP Morgan is generating billions of dollars in profits. That's what I'm talking about. Using technology to gain a competitive edge and drive profitability. Then you've got ICBC, the Industrial and Commercial Bank of China. They're absolutely dominating the digital banking space with over 700 million active mobile banking customers. That's more than double the population of the United States. They've created a seamless mobile experience that allows customers to do everything from transferring money to paying bills to applying for loans, all from their phones. And they're constantly innovating, adding new features and functionalities to their app all the time. They're even using facial recognition technology to verify customer identities and prevent fraud. Talk about convenience. These are just a few examples of how the most profitable banks are using technology and innovation to their advantage. They understand that in order to stay ahead in this rapidly evolving industry, they need to be constantly adapting and embracing new ideas. It's not just about keeping up with the Joneses, it's about setting the pace, being the disruptor, and creating the future of banking. And the best part, this innovation ultimately benefits everyone. Customers get a better experience, banks become more efficient, and the entire financial system becomes more secure and accessible. It's a win-win situation all around. So, as you can see, the most profitable banks aren't just lucky. They're not just sitting on piles of cash and hoping for the best. They're strategic, they're innovative, and they're constantly adapting to the changing landscape of the financial world. Profitability isn't just about numbers. It's about adaptability, innovation, and smart decision-making. The most profitable banks are masters of these traits, and their success offers valuable lessons for us all. Thank you for watching Banking Beyond. If you enjoyed this video, make sure to like, subscribe, and hit the notification bell. We'll see you next time as we uncover more secrets from the world of finance.